Hello everyone, I am here to introduce our audit team. Our audit includes engagement partners, managers, supervisors, and audit assistants. We work together to check the company's financial records and make sure everything is correct. The company we are auditing is Alpha Solar Energy Systems Private Limited. It is a private company in Sri Lanka, started in 2002. The company provides and installs solar power systems. Their office is in Colombo and they help people use clean energy. For the audit, we follow important steps. First, we check for risks like revenue, inventory, and tax issues. Next, we test the company's internal control to see if they follow good financial practices. Then, we check financial records to confirm that everything is accurate. Finally, we review documents and look for any fraud risks to ensure the company follows the rules. By doing these steps, we can give a clear and fair report about Alpha Solar's financial situation. Thank you. Let's move on to the next slide.
Today, I would like to briefly introduce two fundamental concepts in auditing. First, let's talk about the audit risk model. It helps auditors assess the likelihood of issuing an incorrect opinion on financial statements. The model consists of the three key components. The first one is inherent risk. The risk that an error or misstatement occurs naturally due to the complexity of transactions. Second one is control risk. The risk that is a company's internal controls fails to prevent or detected errors. Detection risk. The risk that auditors fails to detect an error or misstatement despite their audit procedures. These risks combine in the formula. Managing these risks effectively helps ensure reliable financial reporting. Now let's move to the materiality. Materiality determines the significance of errors or misstatement in financial statement. Auditors consider different types of materiality. First one, overall materiality. The thresholds for misstatements that count influence decisions. Performance materialities, a lower threshold used to reduce audit risk. The specific materiality is focused on particular financial statement. Clearly, trivial threshold is small misstatements that are unlikely to affect decisions. By carefully assessing audit risk and materiality, auditors provide assurance that financial statement prevents a true and fair view. Next, move on to the next slide.
As auditors, one of our key responsibilities is to assess the accuracy and reliability of financial statements. To do this, we rely on something called audit assertions. Audit assertions are representations made by the management when preparing financial statements. We test these assertions to ensure the financial statements are free from material misstatements. In the income statement, there are 5 key assertions. First, we have occurrence. We check if all recorded transactions actually took place during the period. And then second, we have completeness. We verify that all transactions that should have been recorded are included. Third, accuracy. We assess whether the amounts and details are correct. Fourth, cutoff. This ensures that transactions are recorded in the right accounting period. And finally, we have classification. We check if transactions are recorded under the correct accounts within the income statement. When we move to the balance sheet, we have existence, rights and obligation, completeness, valuation and allocation. And for the notes to the financial statements, we have 5 assertions including occurrence and rights and obligation, completeness, classification and understandability, accuracy and valuation, and lastly, we have consistency. By addressing these assertions, auditors can form a reasonable basis to express their opinions on the financial statements. This understanding of audit assertions sets the foundation for our next steps in the risk assessment for our company, which we will be discussing in the upcoming slides.
Let's talk about relevance of audit planning to practitioners in our field. As you can see from this slide, we have outlined 4 key areas. Improving audit quality. A comprehensive audit plan is the bedrock of a successful audit. It provides a roadmap ensuring we cover all essential areas, identify potential risks, and allocate resources effectively. Secondly, fraud detection and prevention. An effective audit plan incorporates procedure designed to identify and assess the risk of fraud. By understanding the client's business process and internal controls, we can tailor our audit procedure to specifically address potential vulnerabilities. Third one is client assurance. When we demonstrate a meticulous and well-structured audit plan, we instill confidence in our client. They see that we have organized, thought, and committed to delivering high-quality audit. And finally, compliance and regulatory requirements. The audit plan serves as a critical tool for ensuring adherence to professional standards and regulatory mandates. It documents our audit approach, scope and procedures, providing evidence of our compliance. This is essential for meeting our ethical obligation and protecting our firm from potential liabilities.
In these slides, let's focus about the time budget. For the audit phase, planning and risk assessment, we have allocated engagement partner, audit manager, and the senior auditor. Also, we have allocated 50 hours. For the internal control evaluation, we have allocated senior auditor, staff auditor, and we have allocated 40 hours for that audit phase. Fieldwork and substantive testing, we have allocated senior auditor, staff auditor. For that phase, we have allocated 100 hours. Testing and specific accounts, we have allocated staff auditor. Also, we have allocated 60 hours for that phase. Review and supervisor, we have allocated audit manager, engagement partner. For that phase, we have allocated 30 hours. Reporting and deliverables, we have allocated audit manager, senior auditor, and engagement partner. For that phase, we have allocated 20 hours. Final review and sign off, we have allocated audit manager, quality review partner. We have allocated 20 hours for that phase. Now let's move to the do's and don'ts in the audit. For the do's, we have to follow audit plan and procedures, understand the client businesses and industry, maintain professional specs, communicate effectively and regularly. For the don'ts, we have to don't make the assumption without evidence, don't comprise professional ethics and independence, don't skip or rush procedures, don't rely blindly on clients' expectations. Now let's move to the next slide.
When it comes to risk assessment in revenue, we are focusing on verifying the significant increase in revenue and the important in gross profit margin between 2023 and 2024. The financial statement indicates a significant rise in revenue from 515,688,000 in 2023 to 1,036,000,000 in 2024. So this represents an increase of 520,330,000, which raises important audit concerns such as whether the increase is a result of genuine business expansion or potential overstatement of revenue. Factors contribution to this rise and including increased sales, price adjustments, or business strategic changes. So when it comes to the gross profit margin, there are a notable observation in the improvement from 27.11% to 3.40 in 2024. So as an audit team, we have to ensure that revenue and profit margin reflect a true financial position is essential for managing transparency and accountability in finance reporting. Let's see what we'll discuss in the next slide.
Risk assessment in inventory. Inventory risk assessment is crucial in maintaining operational efficiency and financial stability. A significant decrease in inventory, as seen in our financials, can lead to risks such as understocking, supply chain disruptions, and fluctuating market. These issues impact production, customer satisfaction, and overall profitability. To mitigate these risks, we rely on audit evidence like physical inventory counts, confirmation processes, and NRV testing to ensure accurate valuation and stock control. Proactive management helps prevent financial losses and ensures a smooth supply chain. Next, move on to next slide.
Let's talk about the risk assessment in cash and cash equivalent. The table below presents the change in cash and cash equivalent between 2023 to 2024 at Alpha Solar Energy System Company. Let's identify the key risks. The first one is fraud risk. The cash in hand dropped by 89.3 percentage from 2023 to 2024, which may indicate missing funds or unrecorded expenses. Cash at bank increased 31.1 percentage from 2023 to 2024, and fixed deposit increased 20.1 percentage. Audit procedures are count cash and check recorders, review bank statement, and check approvals. The next point is identify liquidity risk. Fixed deposit increase 20.1 percentage may mean cash is not being used effectively. If the bank balance increase is due to loans, the company may face liquidity risk. Audit procedures are check loan and bank statement, analyzing liquidity ratios, review cash flows, check fixed deposit certificates, review exchange rate, and check financial statement. Now move to the next slide.
Let's talking about risk assessment in property plant and equipment. Property plant and equipment balance. There has been significant increase in property plant and equipment from 4.5 million rupees in 2023, 125.7 million rupees in 2024. This increase required risk assessment in ensure accuracy and compliance. Risk assessment evidence for PPE. Physical verifications of asset. Checking of asset exit and are in good condition. Depreciation calculation. Ensuring depreciation is correctly applied as per accounting policies. Review of purchase documentation. Verifying invoices, contracts, and approvals for new asset purchases. Insurance policies. Confirming that assets are properly insured. Ownership confirmation. Checking legal documents to confirm ownership and avoid misstatements. Let's move on to the next slide.
The audit of Alpha Solar Energy System Private Limited highlights significant growth, with revenue doubling from 550.7 million to 1,036 million and increases in gross profit margin. However, key risks were identified, including potential revenue misstatements, decline inventory levels, and liquidity concerns led to a drop in cash holding and increased fixed deposit. To strengthen financial integrity, the company should enhance internal controls, optimize cash flow, and ensure accurate revenue recognition. Additionally, regular compliance checks and improve inventory management will support sustainable growth. Overall, while the company demonstrates strong financial expansion, careful monitoring of risk areas and governance practices will be essential for long-term stability and regulatory compliance. Thank you very much.